Josh, so I'm sure a lot of our clients are seeing either on the nightly news or by checking their 401k plans that stocks in the US are at an all-time high, and they've continued to make an all-time high over the past few years with a little bumps in the road. We should talk a little bit about why this is. You're seeing some of the biggest companies in the market are making up a larger percentage of the indexes than they have historically. What are we thinking about this? How are we navigating this in our client portfolios?
Some clients may remember the tech bubble in the early 2000s. A lot of companies became very large, valuations are really high, and then the tech bubble burst. So we get questions, is that repeating itself today? And when we look at the market, we have some of the same things that are occurring. We have really big stocks making up huge weights in the index. That does make us a little nervous. However, these companies are higher quality than they were 20 years ago. They are very profitable, they have a lot of earnings. So we're not as concerned as what we were 20 plus years ago, but it does concern us.
So is it safe to say that we're navigating some of these risks by maybe not owning as much as the indexes are owning?
That's true. We still own these great companies. We just own a smaller percentage because we want to be more diversified. We also think that there are some better valuation opportunities outside of these really heavily trafficked and talked about stocks.
And maybe we can give an example of how risky these stocks can be at times and how much of a drawdown they can have at times.
Earlier this year, we had a big drawdown in these high-flying tech stocks, and our portfolios held up really well because we were prepared for that.
So where we're at right now, the top 10 companies make up close to 40% of the overall index. And it wouldn't make sense for our clients to own 40% of their portfolios in these stocks, would it?
We don't think so. We'd like to be more diversified. We see better risk-adjusted return opportunities other places.
So going back to building the most durable portfolio possible, we're not owning these companies in the weights that the index are owning them. We're still owning them, but we're spreading that risk across multiple sources of return to help our clients achieve their long-term goals and not taking on the risk of these index concentrations.
While the stock market looks expensive in many ways, the bond market looks pretty attractive, and we're seeing opportunities in bonds, stocks outside the United States, and real assets.
So maybe we can take a second to kind of look at what that looks like outside the United States. The valuations are cheaper, the opportunities are there. Maybe it makes sense that we continue to invest outside the United States, whether it's bonds, whether it's stocks.
Yeah, the U.S. doesn't have a monopoly on good businesses. A lot of great companies exist outside of our borders.
So as we mentioned, we're at concentration levels that we have not seen before in history. How might this play out in the markets?
So the catalyst will always look obvious in hindsight, but trying to figure out what it is ahead of time is a challenge. A lot of these companies are each other's biggest customers. So if you had some cracks in the AI narrative, data center build-outs, another DeepSeek-like innovation, you could easily see these stocks go down and maybe in tandem. But it's really hard to predict what could bring them down. But instead, we want to be prepared, be more diversified ahead of time because we can't predict what's going to happen.
So if we had a crystal ball, it might be a little easier. But for now, what we do is we just truly try to prepare and not predict. So if you're worried about not being diversified enough or maybe owning too many of these stocks that are overpriced, call our team.